Good morning, you guys, and welcome to week 4 of the Business Plan Writing Workshop. This is our final session for this series. Hopefully you have enjoyed the series thus far. And Michelle will be our presenter again today to finalize everything. I'm going to send you all out some documents that she has sent over to me for today's session. If you do not receive the documents, just please put it in the chat. It's put your email address, and then I can forward them right over to you. But I think I got everybody covered. But if not, please let me know in the chat by posting your email address, and I'll forward those right over to you. Without further ado, then we're going to let Ms. Michelle go ahead and get started for today.
Hi.
Let's get this host.
All right.
There we go.
Okay. Good morning, everybody. We're back. How's that? We are back, and first and foremost, I want to say good morning to everybody. I do apologize for the delay. Anytime we talk about doing some forms and getting things together, today we're going to be talking a lot about your money, finances, finance forms, the whole nine. So what I'm going to do first, I'm going to first give a major shout out to Keisha. Y'all, let's give it up for Keisha, who has organized this whole thing from the beginning to the end, that every Wednesday. Yes, let's give it up.
Thank you.
Yes. Give it up for her, for all of her hard work and due diligence to make sure that this session is an amazing session. And I just want to just appreciate her for even asking me to do this session. I love doing this session. And actually, while we were going through this in my timeline, I had some memories last week where the day of, we were actually doing this right there at City Hall. There was about 30 people in the room, and we knocked this thing out in 4 hours. Can you imagine? 4 hours. So you guys are getting 8 hours, and I hope that it has been very helpful for you. So, at the end, I would like and ask that you all evaluate this workshop. Do we have an evaluation, Keisha? Do you have one?
I believe I do have one. I'll send it out with the group as well.
Okay. I was strongly, not strongly, yes, I do strongly encourage you. Please evaluate this project, this program, and the information that you did receive, and how we can make it better, and how can we improve on what is already good. I want to know feedback as far as how have you processed the information? Was it useful? And how can we further help you actually make sure your business is up and running and funded? So I just want to just put that out there and say, please do that. But today we're going to actually be diving into the whole aspect of the finance part of it. And I actually waited to the end to actually do this is because how many of you are like number challenged? Yes. Number challenge. Anybody number challenged? Well, I'm not. I love math. So this is like, woo! Math makes sense to me. But I will do my very level best to not make any assumptions. So we're going to actually walk through this. I want to walk through. There are 3 forms that we're going to walk through. We're going to walk in great detail because you may have a software that would do all of this information for you. I know that Excel has templates in there. Now you got to just put the numbers in. It's one thing to use a software and a template, but if you cannot explain your numbers, having a software really don't matter. So Keisha's going to send out to you all in the email. The Excel are actually what we're going to be putting in today. So we're going to actually practice with an example that I have, so then that way we can actually look at, and then I'll be doing it as we're going through, so you can see how the numbers fall out. So from the beginning, it's going to be a lot of me talking in regards to definitions, because when you talk about finances, it has its own terminology. And when you have its own terminology, you're always about to learn a new language. So that's what I should say. You got to learn new language today. And it's going to be the whole thing of business finance terminology. And so each part that we define today is very crucial to actually looking at the financial picture of your business. I'm going to show you today how you can project and budget, as well as look at your income statement, your balance sheet, and your cash flow, and make sense of it. So you can actually look at it month by month, review how you're doing in your business. Are you spending too much on your inventory? Do you not have enough inventory? Did you have one product or one service that's not getting enough traction? So how do you switch that over in your finances so that the area that is getting the most service, you can continue to build on it and still meet your bottom line and possibly have your break-even point. So are you guys ready?
Yeah.
Let's go. Let's go. All right. Now, here's the thing. Use the chat, unmute, ask questions. Please do not fear, I'm not an expert in this. I understand it, but I'm not an expert. Okay. So we're in this together. All right. So ask as many questions as you want. Understand the numbers, because when you understand the numbers, it makes it easier for you to tell people why you need the money, amount of money that you need, and how much you're actually going to need for your business. So, all right.
Michelle,
So,
before you
yes.
get started, did everybody receive the email? Just a quick, did everybody receive the email? Okay, if you did not, please put it in the chat box. Thank you.
All right. Make sure you got it. So you have a Word document, and you also have a Excel. So what I'm going to do is on the screen, I'll be toggling between the PowerPoint presentation as well as the forms, as well as the Excel. So we're going to be able to do a lot of movement today. So don't get lost. If you get lost, say, hey, I'm lost. And Keisha helped me because I don't have the chat in my presentation.
I'll watch it.
Okay, thank you. So today we're going to talk about income statement. We're going to talk about your balance sheet, and we're going to talk about your cash flow. So, okay, yeah, I forgot to put all these animations in it. All right, so the first thing we're going to talk about today is your income statement. Okay, it means everything that it says. It summarizes how much money your business earned and spent up to the minute that the report is run. So we're going to talk about how much money was earned, how much was spent. But this is what an income statement reports. It reports your revenue over a given period of time. It subtracts all of the costs for you doing a business. So those are your expenses. And it tells you what your net profit is. So this is also called an earnings report or a profit and loss statement. Okay. So pretty much your income statement talks about how much money you have brought in, how much sales, and the income that has coming in, how much of the expenses was actually paid out, and your net profit, how much you made after your expenses have been paid. So this is considered your profit and loss statement. So this is a very powerful form, because this form tells you where you missed the mark or where you exceeded. Okay. So this is the formula. So there's quite a few formulas, and I try to put them all in red. I may have missed a couple, but your net profit is equal to your revenue minus cost, which is the same thing as income minus expenses. So you guys remember when we were talking about how to project what your startup cost is going to be? I think we did that 2 weeks Well, we talked about your startup costs. We talked about all of the possible ways that money can come in. And then we talked about all the ways that money will be spent out so you'll know what you're starting with in order to start your business. Well, this income statement is pretty much something that you review on a monthly basis because you want to see how you're doing or however you set up your review for services and products that you're selling or sharing. So this is what I did. This is the only one that I was able to put inside of this PowerPoint slide. And so this is actually an example of an income statement. So this income statement is an example from a, what happened? Oh, okay. So this is an example of an income statement. And with this income statement, it's talking about the revenue, which is here, the gross revenue, gross profit, operating profit, profit before taxes, and the net profit. So this is done and with a comparative, in a comparative way where you have last year's, let me see if I can use my annotation. Yes. So here we have the previous year, and here we have last year. So this is pretty much comparing how the person did when it comes to their revenue. So let's walk through it step by step. Let's turn it off. Okay. Oh, okay, I want to turn it off. Okay. All right. So for your income statement, your gross revenue is the total number of all sales income without subtracting your expenses, the things that you spent. So that's your gross revenue. So you're looking at all of the jobs that you've done, all of the products that you sold, and you're looking at this grand total after a month. This is how much money you have accumulated through sales. Your profit, which is your gross income, is also the cost. So your gross profit, gross income is the cost of goods sold. It's like a repeat associated with producing, assembling, or purchasing what you have to sell. So when you're talking about your gross income, you're looking at the cost of goods. So if you have to make, let's say, a sandwich, you have a deli shop. In your deli shop, you got your bread, your meat, condiments, your packaging, all of that goes into your gross. Your gross. I would say it's going to be an expense. Okay. The cost of doing business. Your operating profit is you subtract from your gross profit, which is your operating expenses. So when you talk about sales, what I just mentioned about the sandwich, the deli part of it, all of the things it makes for you to run your business, your general expenses, as well as your wages and salary. So that would give you operating profit. Then also that adds onto there is your depreciation expenses. So that means like big ticket items like your equipment, a car, a building, things that depreciate over time. You calculate your depreciation, which is usually a tremendous formula, but you can actually find a table and it'll tell you the actual equipment, and they'll give you a step-by-step how much they depreciate over time. I should pull one up so then you can look and see what that looks like. So what I did was that the gross revenue is in the turquoise, the gross profit is in the green, and then the operating is in the fuchsia, so we can see it on the table more clearly. So your gross revenue, the gross revenue, they had revenue for in-store sales. So this is how much money they made in the store last year. So this is from December 31st. So over the year, the current year, they made $624,000. Catalog sales, they made $105,000, which gives them a gross revenue of $729,000. Now, if you notice on the first column, they're named all the places that they can make money. So they made money inside the store, and then they also had a catalog. So if you're doing in-store online, your online can also be found here as well. So catalogs is usually mail-in orders. On orders also is a part of that as well. So any way that you make money should be listed under your gross revenue, and it should have a bottom line of how much you actually made. So in the comparative year for the in-store sales, you see that they had 595,000. Well, they had an increase of sales the current year, and also an increase in catalog sales than the previous year. So there's a difference here between the 729,000 and 690,000. Now, when it comes down to the cost of goods, there's a negative sign right here. Don't negate this little negative sign right here. That was an error. I couldn't get it off of there. But the cost of goods that they had spent just to make their product and make their things that they're actually selling was $448,000. So you subtract 729,000, 448,000 from 29,000, you get 281,000. So for this year, they talked about how much money they made when they sold also their products. This is the amount of money of all of the product that they had to make, assemble, produce in order to sell. And then you actually down here to the future part, where your operating profit, which is your like for instance marketing, your administration, people that you had to hire in order to sell the products. So these are considered salaries, and then any big ticket item, $20,000 worth of depreciation. So that came up a total of $135,000. So we talk about the money that we got in the business. We talk about the expenses of the product that we need to make and produce to sell, what it will cost to sell those items. Now we're looking at the salaries, the depreciation, and whatever else it took in order for us to sell the product. Then we go down here to profit before taxes. So the dividend or interest. So if you have any type of portfolio or investments, that goes into your income statement as well. If there's any interest expenses, like for instance, you making, let's say you have a loan out for some equipment. There's sometimes you have APR attached to it, which is the annual percentage rate that's attached, which is interest that is attached to that loan. So you will put that in your statement as well as interest that has been paid. So after the expenses, your income, which is like, for instance, investment accounts and portfolios, you get $3,000. You had any interest of things that you paid on was like $24,000. You add that to the 135 and then subtract the 24, you'll get $114,000. Now, depending on the structure of how you set your business depends on your taxes. So if you're a sole proprietorship, they have a way, a threshold that you actually file your taxes. If you're a C Corp, same thing. S Corp, same thing. Limited liability corporations. That's between how you set your structure up and your accountant to determine even like payroll taxes, insurance taxes, sales tax. If for a business, all of those taxes are accounted for, which is like 22,000. So the net profit after everything has been paid out is $92,000. That's just the income statement. So the income statement pretty much tells you the overall course of time. It can be done monthly, quarterly, yearly. You have a great snapshot to say, okay, this is the money we brought in. This is the amount of money it took for us to make the product. This is what we sold. We had some investments. We made some money off our investment. we paid interest, we paid our taxes, and at the end of the year, this is the amount of money, the $92,000 that's sitting in your bank for your business, which is an increase from the previous year. So your previous year and then year to date, because usually when you do, it is usually whenever you do the report is year to date, and it's like a running tab. It's like a running tab. So from $729,000 that was actually made in gross revenue, they actually cleared $92,000 after their and product, payroll, taxes. They cleared $92,000. So, did I lose anybody? Any questions? Because I wanna do it in do it in pieces, so then that way we have a better understanding of how that works. So is it all clear? So if you have a business and in your business you are selling barrettes, if you have to make the barrettes or if you're buying the barrettes wholesale, that will fall into the cost of goods sold. So all of those numbers need to come together to make sense. So you'll know what you're spending on a monthly basis, and then you'll know how to mark up your product in order to make a revenue to cover the cost, like the barrette that you're selling. Any questions?
This is Violet. I don't know why I'm at that. Anyway, I would just say if they're new that they should do monthly statements because you don't want to get behind and not know until 3 months later that you don't have what you like to have.
Ms. Bailey, you got a reverb. Say that.
I'll try to figure it out.
I want to hear what you said. I'm sorry.
I just said that I would recommend monthly statements for new people.
Yes. Yes, monthly. Now I will speak to I run First Ward Community Center, and so today I have a board meeting, and so this lesson I always check our work with our accountant, our CFO, and look at our cash flow and look at our income statement because I'm looking at how many grants came in, which is income, how many donations came in, and we have our chart of accounts broken out so that everything that we have when it comes to income that is coming in, we have it listed out. So I have about 30 different ways that we have income coming in on our income statement, on our income sheet, because he lists out everything that money comes in, because how you handle your taxes makes a big difference. For a nonprofit, it makes a difference because we have unrestricted funds as well as restricted funds. So you may have designated money that may come in specifically for parts and specifically for salaries. All of those income needs to be listed out, as well as the same thing for the expenses. So if you have a mortgage on your building, if you have car insurance, building insurance, your salaries and payroll, if you even to the point of departments in your company, you want to break those out. Like for instance, you have a sales team, a marketing team, and those salaries differ. You can actually earmark those as well, so then that way you can keep track of your payroll. And then calculating the taxes at the end. All right, so are we ready to keep moving? Do y'all have any questions? Are those forms making sense? So, all right, now, if you can open up, I'm going to open up the Excel sheet that I have, and I want to show you all that how easy this is for you to actually use this for your own business. This Excel is a sample of an income statement. And it's, like I said, again, another name called profit and loss statement. It talks about the sales, the cost of goods to give you your product. Now, all of these, let's just say, all of these squares are live, meaning that you can actually put it in, and you can actually play around with the numbers and it will calculate for you. If you look over on the far left corner, it also gives you some of the things that operating expenses, such as salary, overhead costs, payroll taxes, outside services. And as a matter of fact, because this income statement, if you notice a little yellow box right here, it tells you what needs to go in those little yellow boxes to add up. How cool is that, right? And it's yours. You can use it. So here's the thing with supplies: the amount of general office supplies, not supplies. This said this is not supplies for creating product that should go up under cost of goods. So again, this is your direct labor and direct materials. So for Paul, who has his custom painting, the cost of goods and direct materials, direct labor should come in the cost of goods sold. Because the bottom line is, if you ever go to the store, and this is I'm jumping a little bit ahead in regards to like the cash flow forecasting. If you ever go to the store and just actually look at the shelf, and so it'll tell you those bags of chips that come in a bag, and it's like 10 in the bag, 10 in those bags, or 18 in the bag, you know, those variety chips. But if you look at the tag, it tells you that the cost of it is $6.99. But if you look at the small little number, it tells you how much it costs per unit. That per unit is also part of the cost of goods sold. So they took all of that, multiplied by the number of bags that were in there. Like if it was 25 cents a bag, and then they multiply by 10, then, or like 10 cents, not 10 cents. If it's 25 cents, they got 10 in the bag. They'll multiply the 10 by 25 and get $2.50. That is the total unit. Okay, does that make sense? Because when I start talking numbers, glossy eyed, like, ooh. But I hope this is making sense. But this is an actual live document, as I was saying. So you got your office supplies, you got your repairs and maintenance. Please, in your budget, when you're talking about dealing with your budget, your actual operating budget, always, again, I said it before, have some maintenance money in there because life happens, things break. Advertising, car delivery and travel, accounting expenses if you have to pay for an accounting, legal if you have a lawyer, rent if you're renting space, telephone, utilities, insurance, taxes, interest, and depreciation. All of these information, it will come up to a total right here, a total operating expenses. So this income statement is pretty much a standard that you can use. If you notice, the numbers that I put up here for the gross profit had already started calculating the profit and the loss before taxes, the net profit, loss after taxes, and then your actual how much money that you made. So let's just say our operating expenses, let's say salaries, let's say 25,000. Payroll is roughly about 2,500. I'm just going to say 10%. Sites, roughly $300. Advertising, $500. Let's see, our rent is $300. Telephone is let's say $50 because we got a boost. Utilities, consumers, about $500. So your total right now, our total operating cost is $29. Okay. Now, if you look at our gross product, our gross profit, we only made $23,000. So that means that we're over $6,150. This is not good. Okay, that means that we didn't sell enough product in order to cover our monthly expenses. So either you're gonna lay somebody off. Let's bring that down to 18,000. And then if you lay somebody off and you keep all your other expenses the same, you will make $850. So this checks and balances right here. If you are not making enough in sales, or you can even not even lay anybody off, but you can reduce the amount of it takes for you to make your product. So let's just say we reduced our cost down to $50,000. We shaved that off and we hired a person back. Oh, not 250. No. Oh, you say you want to replace it? Yes, I do. All right. So now I reduced the cost that it takes for me to make my material, because at first it was at 75,000. I cut that down by 25. I hire my person back, and now my bottom line now is at $18,350. So juggling between making your sales, reducing the cost of your product to make your product makes a big difference in your bottom line. So if you're using all premium, premium parts and premium, let's say liquor or premium items in order for you to sell your product, that's going to go to make sure that you have a great balance with your sales. That whole markup is important because you want to make sure that you're making money to cover your expenses and to have your bottom line. Are there any questions on the income statement? Let me look at you. Good morning. Any questions? Has anyone done an income statement? Miss Violet and Keisha. Paul said, okay. Did I miss anything, Miss Violet? I'm leaning on you.
The form's excellent, especially since it shows you what you want to put in each of the categories. I think I figured out the reverb problem. It's where I logged in twice.
Oh, okay.
So, yeah. And so usually, I saw how you were doing this and stuff, but I wanted to know about where this came from. If you developed it, could we make it into a workbook instead of individual spreadsheets?
Yes.
Okay.
Yes. I would actually do that.
Oh, thank you.
That makes a lot of sense. Yep, I can actually do that because I was just running through them and I was like, oh my God. And I didn't think to put them all in a one workbook, but I can actually do that and resend it out to Keisha. So what she's asking me is,
that just means that there'll be names on the bottom of it all be in one packet.
All in one packet. Absolutely.
Thank you.
You're welcome.
Paul says he's been using QuickBooks.
Does it work for you?
I like it, but I guess I just kind of got it only because I have like the lack of knowledge of record keeping for everything.
Okay. So was there any clarity with the income statement as far as what those numbers mean? So when you actually look at it and run one, because you can run one right now and look at it and compare it.
Pretty much everything's been a total loss, not a pocket anyway. So we've just been kind of taking the hit. No, I'm just kidding.
You gotta flip that.
I'm trying.
All right. So So are y'all? So are there any more questions? Please use the chat because we're gonna keep walking. We're gonna go ahead and continue to walk through.
Hey, Paul, that's not unusual to lose money, especially the first 1 or 2, 3 years. That's why they do the 3-year production, projections and stuff. So, if you figure out what your issues are, then you can resolve them hopefully within the next period of time as you move forward.
I was gonna say it was all just I was just kind of a hobby in the garage for a while, and then like up until recently, the past I think I've been in my building for 2 months now. We've been doing the renovating, so I'm just really getting started out. So
Okay, that makes sense. Okay. So let's move on to our balance sheet. And it says exactly what it means. We're going to find some balance. Okay. So we're going to get ready for some more terminology. All right. So your balance sheet is a snapshot of what your business is worth, how much your business is worth at any given time. Kind of make sure. Okay. So here is some more terms. Assets. Assets is what you own. Assets are what you own. So that means your equipment, your building, cash, your investment portfolio. We'll go through it. Liabilities is what you owe. Okay. You can use assets and liabilities in many forms, personally, financially. You can use it because people are liabilities too. Those are the negative people. Assets are the people that add to you. All right. The difference between the two is what your company is worth is known as equity. Equity. Equity is the difference between your assets minus liabilities. Okay. You'll get this PowerPoint presentation, so it'll make more sense. So equity is what your company is worth. If you ever watch Shark Tank is a very good way to learn about making investments and people investing into your company, because when you talk about equity and how much it's worth, there's that it tells you my company is worth $1.1 million, and the equity the worth is $1 million. But if you're looking for somebody to invest into it, you're giving them part ownership of the worth of your company. So if you're talking about a person giving them 10% equity in your company, that means you own 90%, they own 10%. So $100,000 up to the value of your company is what they own. All right. Total value of assets must equal the total value of liabilities plus equity. Okay. So this is usually done the last day of the year and is comparative with the other years. So when you're doing your balance sheet, you're looking at all of the things that you own, all of the things that you owe, and you're calculating to find out what is the actual equity or worth of your business. So let's talk about assets. What are assets? So you have current assets. Current assets are all items your business owns that are liquid enough to be converted in cash. So that means that all your assets that you have in your business, it can be turned to cash, and it's not that hard to make it liquid. Assets, cash, investment portfolio, account receivables, money that's coming in, inventories, the product that you actually have stored or things that you're making, that's your inventories, and prepaid expenses. So when we talk about assets, these are all considered assets. So if you have an investment portfolio, that can become liquid. If you have account receivables, that means that people are paying you and for whatever service they pay you, that's assets. So your account payables is not cash on hand, because it's what people owe you. Okay, so you can actually have that on your books that you have outstanding money, the money that's supposed to be coming in. Your inventories are all of your products and services that you actually have, either that's physical or it could be, when I say physical, like for instance, barrettes or whatever it is that you sell that's tangible, in a warehouse or somewhere stored, or even food. Like for instance, you have you buy food in bulk because you be making lasagna. That means all of your noodles and sauce and cheese and ricotta, all of that is considered part of your inventory, and it has a numeric value attached to it. Prepaid services are services you haven't received yet, like a professional retainer or insurance premium, that you actually are that you actually have on hand. Now, another term is fixed assets. Your fixed assets is just that. They don't move, but they have value. So that means land, buildings, equipment, and accumulated depreciation. Those are all called fixed assets. Okay. Intangibles. Intangibles are assets as well. It's exclusive contracts, franchise ownership, hard to get licenses or permits to do business, a patent, or even your production process is considered an access, because you may do things a specific way that give you an edge. That has a cost to it. Intangible mean that you really don't know, you know an approximate value, but it can be higher. So you pretty much produce intangibles, like a patent. You don't know how much you can sell your patent for unless somebody offers a price and you say, well, it's really worth more than that. But at least you know in your mind what amount of if you want to sell a patent, how much you want to sell your patent for. That means somebody could even pay more, which is even more of an asset. Okay. And then when it comes to total assets, it's all assets added together. Fixed, your fixed assets, intangibles, and your current assets all make up your total assets. Any questions? Okay.
How do you owner investment? Like Paul putting money into his company to start it up. How do you deal with that on the balance sheet or on the income statement?
I'm sorry, what was the question again, Ms. Violet?
Like if Paul is the owner of his company and he puts his own money in his investment versus an outside person, can you put in owner's investment as an asset and as a liability so that he can pay himself back once it makes enough money?
Absolutely. That will be considered as part of the cash receivable. He will make himself like a vendor because he has part of that equity in his company. So yes, he would. Because the bottom line is you want to, once he becomes an account receivable, he become account payable once he's able to pay himself. He will invoice himself or even put it in a form of salary and then pay himself out of the company. So that should also be something that's done in black and white as well, that you're going in contract with your company. So then that way it's not seen as if you're just taking money. You want to have a paper trail of how the company is supposed to pay you. So if you have an S corporation, the S corporation designation, and make sure I have this right, is that when the company is, you're taking a paycheck from the company, and the company is paying you a set dividend from their profits. That makes sense? So this depends on how you structure it. So, but if you're a sole proprietorship, then you want to make sure you have a separate account. So those assets are just for the business, and you can pay yourself out of that as well. But all of it has to do with taxing, how you get taxed by the IRS for your business. All right, so the next term that we're going to talk about is liabilities. Now, liability is the amount of money you owe to creditors in the forms of bills that are due. So you have account payables. Account payables could be utilities, phone, office supplies, professional services, raw materials, the things that you need to make your product, wholesale goods, invoices for providers or suppliers. Those are the invoices for suppliers and providers is what you're paying them. So you're paying somebody for a service. Those are account payables. Accrued expenses, salaries, wages, insurance premium, interest on bank loans, and taxes are accrued expenses payable. So that means these are the things that are done on a like they're done routinely. So let's see. Working capital. Working capital is the current assets minus current liabilities. So your working capital is pretty much how much money you working with based on the money that you have on hand and the current liabilities that you're actually paying out. So your total liabilities and equity it sums up the value of your company's assets. So here's the formula for that. The formula for that is current liabilities plus long-term liabilities plus the owner's equity equal assets, total assets. So liabilities and assets should equal, okay? Whatever you're bringing in and whatever you're paying out, it should balance out. However, when you're talking about your balance sheet, it actually talks about everything. Okay, again, your balance sheet talks about the worth, how much your company is worth, and the equity. So we talked about land, we talked about cash on hand, we talked about loans and salaries. All of that goes into play in order to make your balance sheet. Okay, so let me stop sharing and let you an example of our balance sheet. Are there any questions? Is this making sense? I like numbers. Woo. At this time, people's eyes get glossy, but I'm going to tell you this. Don't let your eyes get glossy. Don't get overwhelmed, because this is where the money is. And I'm going to tell you, you're going for any time a bank loan, these are the forms that they're going through. They're going to come straight to see where this money is coming in, how is it going out, how much is worth, how much can they choose to invest in your company. Okay, so this is the balance sheet. This is what it looks like. Up at the top at the corner here, you got your assets. You got your year one projected and year two and three projected. Your current assets is banking, cash in the bank. How much liquid cash do you have? You have account receivable, the amount of money that's owed to you. You have inventory. So this is everything that you have in order, all of your products and everything, raw goods, finished goods, materials goes in your inventory. Prepaid expenses, advanced insurance payments, what else did I say it was? Oh Lord, and I lost my thought. Oh, but it's right here. So it's like things that you haven't expended, but until a future date. So it's like at your advance, you have money on hand, but you haven't spent it yet. Okay. Deposits, the amount of prepaid deposits for your company, and then any other current assets that you actually have on hand, and then you'll get a total current asset. So if you have, let's just say, $10,000 in the bank, you have, sorry. $10,000 in the bank. You have people owe you, let's say about $5,000. Inventory, you have roughly about $40,000 worth of inventory. Any prepaid expenses, let's say you put it aside, you got roughly $2,500 just for that. Right now, your current asset, just liquid on hand, is $57,500. Now, when we talk about fixed assets, we're talking about machinery, equipment. Now, there is an actual depreciation for, you can actually Google depreciation of different equipment, and it'll tell you over 1 year, 5 year, couple of months, how you should be depreciating those items. What happens is, if you know about when you buy a car, they say when you drive the car off to the lot, it depreciates 50%. Meaning that if you bought a car for $10,000, you drive it off a lot, the worth of it is now $5,000 because it depreciated $5,000 when you drove it off the lot. That's an extreme case, but that's what they're talking about as far as depreciation. So you depreciate and calculate depreciation for that car if it is owned by your company on a monthly basis. And there's a set chart that tells you every month you subtract this amount from that car. After the life of the car, it should get down to zero, where there's no value and you probably need to buy another car. And when it depreciates, furniture and fixtures, like your office furniture, lights or whatever else that you need. And there's also a depreciation for that as well. Your total improvement made by the company. So if you're talking about making improvements to your actual fixed asset, it also has an depreciation attached to that as well. Land and buildings. Any land that you own, any building that you own, also depreciation is attached to that as well. And other fixed assets. So it says that total value of other fixed assets that do not fit into any of the above categories, such as vehicles. There's a depreciation for that, and then you actually have a total of what those depreciation total of all your total fixed assets. Now, we talked about intangibles. Non-physical assets owned by the company, like intellectual property, again, patents, and different things of that nature that, you can put a value on it, but you just don't know, but you can actually project what that amount be. That'll go in your assets as well. Let me just remove this. Undo. Let's see. What if we build a shop race car for marketing and advertising? How do you depreciate that? You would depreciate a shop race. Can you actually speak your question? Because I want to make sure I understand.
No, I meant like if we have a car that we're building, and we kind of want to make that like our rolling advertisement. So everything that we do for powder coating, I want to apply it to the car and just completely go overboard with it. So we'll be doing like a lot of car shows and like car events and stuff like that. I was curious, is there a way that I can, the total cost of going into the car, it's going to be a pretty good amount of money. So I'm just trying to figure out if there's a way that I can try to write that off.
Okay, so you would take the actual value of the car, and then you would add up all of the labor as well as materials for the paint and everything that you do on it. It has to have a value on it. And then from there, over the course of time, there may be probably a table on there in regards to the life shelf of your paint or your custom paint, the life shelf of the car. So all of that can be added. Once you get a total price on that and you look at it, then you will pull up as far as the vehicle, what like, I don't know exactly how that would look in regards to the custom paint, but there's probably a value that's attached to that because of the life shelf on it. Then you can actually total that and then do a depreciation off of it, off of the total value of the car with all of the custom bells and whistles. That makes sense?
It does. Thank you.
Okay. So that means you got to
That was
add everything that has to do with that car, you're going to add it up and say, this is the bottom value of that car.
Right. But since he's using it for marketing, can he put any of it in marketing expense and
Yes.
get rid of it faster, maybe? Yeah.
Yeah.
Thank you.
Did you?
I caught a little bit. She said I could put it as a marketing expense.
Yes.
Some of it.
Yeah. Because the part that's not depreciated, the value. Okay. So when we get down, so that is all your assets. When you get down to your liabilities and equities, your current liability is your business debt and obligations you have, including wages, taxes, account payables that are due within a certain period of time. So you also have your account payables that you have to pay the creditors. You have your interest payables, that the interest that's due, that to be paid within 1 year. But there's interest on loans, there's interest on equipment. All of that interest gets tabulated. You have your taxes that are payable, that are due at the end of the year. They said this is due in 1 year is short-term loans owned by your company. So there's some agreements that you'll go into that you're going to pay within 1 year. Like for instance, just to get you up and going, or to help tie you over. Like for instance, a short-term note would be the payroll protection plan. Even though you don't have to pay that money back, if you don't fill out the form, you got to pay the money back. But that was pretty much like free money. So you want to put that on your books that, okay, even though it's going to be forgivable, it's still a liability on there because it was used for your business. And it's short term and it has to be paid, have to be used by December 31st. Long-term debt that you actually have that will be over a period of time that will go from year to year. You want to make sure those are also on there as far as your liabilities. Long-term debt would be bank loans, loans to stockholders. So if you actually have stock in your company, over a period of time, you have to pay out dividends for if you have stocks. And any other long-term debt that don't fit in one of those categories. Now, when it comes down to your equity, those are your total assets minus liabilities, which is also known as net assets. So that's meaning the net asset is the actual worth of your company, how much your company is worth after everything is done and paid for from your liabilities. So after all of the depreciation, after accounting for all of the loans and all the interest that is paid, your income, which is pretty much your assets, it really should balance out. Let me move this 10,000. It should equal each other. So the assets should always equal liability. Okay. Let's see here. All righty. Are there any questions? I know I knew we was gonna lose. Paul and Violet are only two hanging on there like, oh. So here's the thing. What we're talking about, your income statement and your balance sheet, your profit and loss. This is the most important part of your business plan. If you understand how you make your money and where your money is being spent and what it is that you own and how much that you owe, when they look at that balance sheet, they want to know how much debt is your company in before they give you money. They want to know, do you have enough products and sales? Do you have enough personnel? Or even are you in the right market to make sure that your company can thrive? That if they loan you money, you can show them in black and white how you're gonna pay that money back. Okay, so I know this is like ooh, numbers. But this is where I'm telling you, this is where the bread and the butter is. If your money, if you are tight and you actually have your executive summary, most times on the executive summary, they're going straight to the financials. Then they go to your management to see who's running it. Because the character of the person that's running it takes the number person who's going to be responsible for handling the money. So between your management team and the owners of the business and your actual profit and loss statement and your income statement, that is what people look at. Keisha, am I right? Talk to me. Share SEDC story.
You are exactly right, Michelle. I think as an owner, lots of times I'll use you for example, Paul, because and it's okay. A lot of us appear to be nervous when it comes to numbers. Maybe we don't have the numbers background. That's okay. But you can be taught to have an understanding as to what these numbers mean and what these statements are trying to get across. So as an owner, I think it's imperative for you to understand the statements. So even if you had to take a basic accounting course, accounting 101, I mean, I understand because I've been taking accounting since I was in high school, and then I was an accounting major. So that speaks to that. But I think that if you just took one basic 101 accounting course or bookkeeping or some type of management type class, I'm sure they have some things online you can research, so to speak, and you probably could get an understanding, maybe even going through like a YouTube tutorial on financial statements, because they explain it all to you. And so you can get that basic concept and understanding because, for example, I have clients to go to the SEDC board before the board, and you have the opportunity to get 5 minutes and you get to present to the board. So you get to speak about your company and you get to sell your company within that 5 minutes. So, but I have already created a proposal and your business plan and all of that, and I have already given that information to the board. So they've had the opportunity to review the information, come up with their questions, see if your income statements make sense. And so this is their opportunity to ask you a question. So when you get that opportunity, you definitely want to be able to speak to that opportunity informatively and know what you're talking about. Because number one, if you can't speak to that opportunity informatively, then why should they lend you money? They won't feel secure. The goal is to make them secure with giving you the amount of funding that you're requesting or that you're asking for. You wanted to be able to answer questions. And so these are financial people as well that sit before the board. So that's why it's so important that you understand and have some sort of overview as to, okay, how does my numbers and my written piece of my business plan go together? How can I make these two make sense for me? So it's very imperative. You can pay somebody to do your business statement. Your business plan. Okay. But you still need to have an understanding as to what it's saying and how it's saying that, and how in the business plan is saying that you're going to execute. Because these are all of the things that investors, lenders, financial institutions, anytime somebody comes to you and say, Paul, we want to partner with you with P2 Customs. We think this is a great thing that you're doing. They're going to first thing I ask you, Paul, do you have your business plan in place? So with that being said, that's why it's so imperative. That's why it's so important. That's one of the key factors when applying for SEDC funding is your business plan, because this is how you're going to get the board to know who you are, what you're doing, what you're offering, how you're going to sell this product or service, how much it's going to cost, how long is it going to take, what is your future goals. So this is their opportunity to learn everything about you. And then it's my opportunity as well, because I may ask you 1,000 questions, because I have to be able to speak to any question that they ask, because guess what? After you leave the room, then I speak on your behalf. So that's a little bit of how the process goes and why isn't so important. And then that's just one instance. So SEDC is just one entity that may be asking you all these questions, makes asking you all this information. But you're going to have, on any level, when a person who is truly serious about investing in your business or bringing you on or being a part, they're going to ask you for your business plan.
Absolutely.
So why not be prepared?
Yep.
But it's doable. I mean, I feel that I know it could be probably intimidating, because it's a process. But just to speak to how that, process, in my grad education, I did a whole semester. My class is to create a business plan. For that whole semester, we did a business plan. And we had to create the business from beginning to end, do the financial, the whole thing. And so it is timely, but it's definitely beneficial.
I will just account to that. So, Paul, you had a question? You about to say something? Oh, so I will say this. When I opened up the funeral home, and I actually sat down and I learned this. Now, by the grace of God, I didn't know anything about opening a business, but I went and found tools. The B plan where I took you guys last week. Listen, B plan became my friend. I even purchased a funeral home template, business plan template. It didn't cost me a lot of money, but I ordered it because I wanted to get more idea of what they were asking for. And I had an idea because I'm not a mortuary science person. So, but business makes sense to me. So when we got down to the whole brass tack of calculating everything out and how income was going to come in, even to the point of ink pens, we had that slated in because, when you got to go sign those papers to when you with your loved one, we gave away pens, and people use pens. That was a part of our expense. So every single thing we actually listed it, how money was going to come in. So when you look at a breakdown, God forbid you actually go through this process before. But when you actually have to bury a loved one and they sit down with that sheet of paper and they shop these packages to you, they shop not only the casket, the spray, which is the flowers, the lining, depending on what kind of casket you're getting, the services. If you look at their cost sheet, the inventory cost sheet that you're looking at, that is part of the whole income and revenue of your income statement. Every service is listed out how they're going to revenue money, how they're going to get money. That's why you have a high-end casket and a low-end casket. Even when I say low-end, all the way to DHS. That's part of the business. So you need to know how much money you're going to make off each one of them, and then you do a markup. Because you probably buy that wholesale, but you want to make money. That's why it's good to be a good consumer to know what is out there, so then that way you'll know how much of a markup are you actually paying when you actually go into specialized businesses. So for the funeral home, I actually research every possible thing that we can make money on, and I research every possible thing that we had to pay out. So when you talk about your business, everything that runs and operates the business has a dollar attached to it. You have good managers to keep watch over your stuff. Because them ink pens, those are not just pens you just pick up and put in your purse, people, or in your pocket. No, there's a cost to that. Put them pens back. They belong, that's work equipment. Because they got a dollar attached to it. People think that's funny. It ain't funny. Because that's money. Lisa, they're cracking up. I'm just saying, sis. I'm saying that's money. Even to the point of brochures, advertising, paper that you make in copies. All of that is money. So you want to be mindful of where your money is going. Because if you running off a program and the margin is off or a letter is and you throwing that paper away, that's money. So how many reams of paper you gonna get rid of before you get it right? No, ma'am. No, ma'am, Pam. So when I went before SEDC to get the money for the funeral home, I mean, I shopped it like I was on Shark Tank. Now, I would encourage you all, if you're interested in owning a business, to go and look at how they tell their story, because that's exactly what it looks like when you go to SEDC. It's a table full of people.
Yes,
and
it
you're standing there
is.
with your podium, and you try to sell them your business so they can give you the money. And I'm gonna tell you, some of those questions, it's okay to say, let me get back with you. I don't know. It's okay to know. But if it's something that's major, that's not acceptable if that's a key component of your business. So when we were talking about understanding your business in the beginning, so I'm like sort of kind of doing a summary, because we still got a cash flow to do. But once we get to the cash flow, then I should just go ahead and do cash flow. So then when we do cash flow, we can sum it up. So then that way you have a well-written financial part. And then we can do that. So let me.
Now, do you have a break-even analysis form?
A break even? Yes. As a matter of fact, let me pull that example up.
Because if it has the definitions like these two, I think it would be really helpful.
Okay.
To figure out the product. I would like to know for myself. Yeah.
Let's see here. All right. I'm going to share my screen because I actually pulled up one from the B plan. Ha ha.
I've been using that too, Michelle. It's very resourceful.
Listen, it's like the ultimate cheat sheet. Well, ain't even really a cheat sheet. It's just a good guide. Okay, so this is what Ms. Violet about in regards to the break-even analysis. So the break-even analysis is when your business will benefit how you're making money. So this is $0. I'm going to break even. This is a profit. This is a loss. So when you're looking, this is for a carpet cleaning business. Okay. It says, I'm just going to read this. It says the business will benefit from a low monthly break-even point due to the assignment of most costs directly to the cleaning service, gas, cleaning crew, cleaning products, and a low payroll is achieved by leveraging the administrative costs. So here's the thought. You want to have a low break even because your salaries, equipment, and vehicles, all of the expenses, you want to get them as low as possible. So then that way you can, like for instance, in this, okay, so I'm trying to see, make it make sense. Okay, let's use this example. No services, we even. Okay. 100 services, they're $20,000 in the hole. It's not until they get up 700 services that they actually break even. When they got to 1,000 services, we're actually making almost about $10,000, $11,000. So there's a point where you're like Paul, what you're talking about right now, we're putting in money, so we're losing and loss. That's okay, but you got to find your sweet spot that the number of services that you're actually offering is matching the amount of money that you're spending. Does that make sense? So you want your services to match to the point that you're not taking a loss, but it's like, okay, we need to do 5 cars in order to break even. So your goal is always 5 cars in order to break even. If you do 4, you're going to have a loss. If you do 6, you're going to have a profit. That makes sense? Yes? I'm sorry, I can't see nobody.
Yes.
So here's the thing. This is, and we're going to talk about this. So let me go to the whole point of the cash flow. Oh, where's my PowerPoint? All right. With your cash flow. Now, cash flow tells how much money is flowing in and out of your business over a period of time. This is very important to know your, because you want to know, you can do it on a weekly basis, bi-weekly, monthly. I would say do this monthly or weekly, depending on the type of service that you're actually offering. You're looking at the total funds in, which are your receipts on sales, dividend and interest income. So if you got some investments and you have some things out there that's making some interest, you want to count that in. And invested capital. Total funds out is the cost of goods acquired, sales, your general expenses, administrative expenses, interest expenses, taxes, building and equipment, long-term debt reduction, and distribution to owners. So when distribution to owners, pretty much your stakeholders or stockholders that are in your company. So with your cash flow, you want to make sure that you know how much money is actually coming in on a given time. So let's say this. Every dollar coming in be attached to dollars that are going out. That's the cash flow. Cash flow also talks about the health of your budget on a weekly or monthly basis, because you can get to a place like, for instance, have a line of credit. Your line of credit can be used to help your cash flow. However, you don't want to live on your line of credit, okay? Because with your line of credit comes interest. So that means you're giving money away by borrowing money in order to keep your business afloat. So when you talk about your cash flow, you want to be able to look at your cash flow and say, you know what, we look on a monthly basis to say that payroll is $5,000. Our expenses total up to $10,000 total, including our payroll. We want to look and see what money do we have coming in that's going to help keep our cash above what we needed, above our expenses. So then that way you can always look at your bank account. You can always look and say, okay, this is how much money we actually have coming in and going out. You want to track every single dollar. That's why Lisa was laughing when I was talking about them ink pens. That's part of your cash flow, because you purchased that. That's part of your inventory. So let's go to our example. But that also ties in with the whole thing with the break even. Oh, where are you? Where are you? Hold on. Let me see. Minimize that. Okay, so here's your cash flow. Let's share. Okay, cash flow. All right. Cash flow. We have your categories on your left column, your cash on hand. This is the amount of money that you actually have in the bank or in your petty cash or money that you have readily accessible. Cash receipts is all your goods and services. So we're talking about all of your sales, your credit accounts. So if a person got, like, let's just say you have a business and you have the actual credit card for your company, that, like a Macy's card or a Walmart, Sam's Club card or things like that, you can have those. That would be considered cash receipts because people are making purchases and actually paying. Loans from outside sources that can give you money. For instance, the payroll protection plan money. will be part of your cash receipts. Cash paid out. So your purchases, your wages, outside services, which could be your professional or subcontractors, supplies. Again, if you look at this cash out, it looks similar to your expenses that was on your income sheet. Aha. See that? It looks just like your expenses. And it also looks like your liabilities on your balance sheet. See, it all is three different ways to say one story. And you have people that look at it and say, you know what? Some people like the cash flow. Some people like the balance sheet. And some people like the income sheet. It just depends. But all three is three different perspectives of how the financial health of your business. So you also have down here reserve and escrow, and down here at the bottom, your cash position is cash on hand minus total cash paid out. Again, income, gross income or gross profit against your total expenses minus your total expenses will give you your money that you actually have on hand. Ta-da! So you're pretty much saying the same thing, but if you look at also your cash on hand, you're looking at this on a monthly basis. Okay? On the monthly, the reason it's so imperative for a monthly basis, because this is also going to the whole thing with forecasting. Now, with forecasting, you're actually looking at your services and you're giving yourself a SMART goal that after a certain amount of time for each week, or let's just say daily, weekly, monthly, you are setting a goal for your forecast. When I did the funeral home, we forecasted the number for 3 years. We forecasted the number of funerals that we wanted to have. I know that sounds so morbid. I know, right? How many people gonna die? All right, but hey, that's a circle of life. So we started off with something that was very reasonable. So if you have one mortuary, one embalmer, how many bodies can a person embalm daily? People can, how many bodies can be prepared, services rendered to have many funerals can be done in a week. That goes into your payroll. It goes into your inventory. It goes into labor as far as for embalmment, hair, all of that. Dealing with the family, that's a cost as well. So when you have to factor in all of that, we started off, we was like, okay, base minimum, we're going to do, I think we said 3 funerals a week. We're going to say we want to make this amount of money. So we said 3. And every quarter we went up by 1. And so by the end of the year, we said that we're going to do at least 6 funerals a week. That was forecasting. And it had a dollar amount attached to it because under each forecast and each service, we said we can use the different packages. So we were interested in selling the base package all the way to the elaborate package. How many elaborate packages that you want to sell? So, unfortunate, we are emotional creatures. When we buy things, emotional consumers, and depending on how much we love our loved one, we'll spend up to $25,000, $30,000 for a homegoing service. I love them, but the money be well spent on this side of it. So we just want the basic package. As a matter of fact, I'm calling Costco because y'all caskets are too expensive. I'm gonna get the same casket at less the price. That's a consumer. Now I actually did that. I learned so much. Like, see, let my aunt rest in peace. I'm gonna share this story with you guys. Now, I'm telling you, as a consumer, you need to know your market, because the bottom line, people are out to get your money. We talked about that, right? Your discretionary funds, people are fighting at the bit. That's why that's why everybody's doing all this wonderful advertising to get you into their stores. Now, Target has done, I'm sorry, I just jumped a little rabbit hole. Target says that Black Friday is every day in November. So you don't have to wait to Black Friday in order to start spending your money for Christmas, because every day they got some beautiful little sale they're going to offer you, a beautiful little item or deal they're going to offer you every day during the month of November, calling it Black Friday. Right? So they're fighting already right now for your discretionary funds, and we're not even in November, but the advertising is already out. So I went on Target's website yesterday just to see what kind of deals they had. Do you know they already got the Christmas kid toy catalog already out? So I'm just saying, when you're thinking about those types of things, it's just like, how do we get your dollars? And people have already forecasted, Target has probably already forecasted that since the catalog is out, we're going to see for the month of November, how many of these items these deals are we going to be actually selling, and at what price? So that's the kind of flow you want to get in. And I mean, as a business owner, yes, you want to be empathetic for your customers, but then on the side, they're consumers, and you're trying to reach your bottom line. Now, don't do anything unethical to get people's money. Don't lie, don't cheat, don't steal. That's a surefire way to close your business. But everything ethical, if they're coming to your business, give them the best possible service possible, and sell them your top model product. But then too, slide on down to make sure, because you never know. That budget may not make it, but they still want to get you to sell. Okay. Any questions? This is the part that if you're not really a shark, this is where you lose your money, because you're too busy counting people's pockets. And when you're in business, stay out of people's pockets. That's none of your business. None of your business. Okay? If you look at them, like for instance, there was an episode on the Cosby Show. So Dr. Cosby went to go buy a car from Sinbad after he went to the dealership, and he looked like he just didn't own nothing, because he looked grunged down the whole nine. Now everybody know he was an obstetrician and a doctor, so he took Theo with him. So the guy, the car dealer, was trying to make a deal to get him to sell him this expensive car, and Theo was like, "You can afford that, Dad. You're a doctor." And so the whole thing, in that dealer mind, his eyes lit up like, "Oh, so you're a doctor. So let me show you this." Here's the thing. A lot of people come in unassuming ways to try to get a deal. And if you have a good consumer, most times they're not going to pay full price. They're going to negotiate the price. So you need to make sure you have a threshold for people that negotiate, because some people are not going to pay your full retail, and you should be okay with that if it's a profit that you can still make on your service. Now, I'm not saying just give your service away. I'm just saying be wise enough to have a threshold of a point that you won't go below for your service, but make it enough that you can make a profit on both ends, regardless if you negotiate or not. Does that make sense? Okay. All right. So I think I have, I think I did everything. Let's see. I'm checking my list and checking it twice. Want to find out who's naughty or nice. All right. So I've covered everything today. So let's recap. Woo! We started off this series. We're talking about our customer and client, knowing who our target market is, knowing the industry that we're diving into, knowing some of the trends of the area that we are, that of the industry that we're in. Excuse me, my nose is itching. We talked about creating a mission statement and vision statement. We need to know where we're going because we need to make sure that our investors, ourselves, our employees, everyone is motivated to keep moving forward. And they need to know where they're moving to. We talked about our product. We talked about our marketing plan, which is totally just like a business plan, but it talks about how you're going to market and how you plan on selling your product, which needs a lot of details into it because you want to make sure that you're crossing your T's and dotting your I's. Then we started talking about the whole thing in regards to the makeup, the components of our business plan. We talked about our management team who are and having their resume. We talked about locations. We talked about a lot. We talked about today our finances. Wrapped it up with the finances so that way you can have the best picture to give to the investors for yourself so that you can continue to grow and chart the growth of your business. And you can actually, everything that we talked about is very fluid. When I mean by fluid, it can change because things become obsolete all the time and things increase all the time. So when you look at it and you look at your market and you're in touch with your consumers and your clients, it makes it very easy to say, okay, well, we may do a little tweak here in order to do the things that we need to do in order to make sure that we stay on top of our game. Have a 3 to 5 year plan and look at your business plan all the time. It's a living, breathing document. It's not something that you do just to say we got the money, but it should help you chart how you want to grow your company and find different ways to improve your company or even to expand your company. Business plan writing, it can be as easy as you want it or as difficult. It is tedious. When I opened up the funeral home, it took me, for us from start to finish, 18 months. 18 months. And when we actually got it done, it was like, oh, okay, how do we move? But he still uses business plan now because he got a location in Lansing. And then he was talking about doing a location in Arkansas. But the bottom line is he became a very good client of SEDC. And he paid his money off. Hired people and paid it off. And asked for more. So you can keep going if your stuff is right. Because they have money available. We have a couple of minutes left, about 18 minutes. I'm very excited to have been able to present this information to you all. I hope this is not the last time that I'll be doing this for anybody that will be interested. Keisha is available. That this is what she do, and whatever she needs me to do, I'll be here to help in any way possible. All of the forms, and I will provide the PowerPoint presentation. I'll send it to Keisha along with all of the forms, so then that way you'll have it. I'm going to create that workbook, so on the cash flow, the balance sheet, and the income will be all in one Excel file, so then that way you'll have all of them there. It'll be live. And just do a save as, so you can make as many as you want. For the areas or for different parts of your business. If there's anything else, any other questions or comments, if you're still fleshing out ideas, continue to flesh out the ideas. Take what you got the template, use that, answer those questions that's inside the template, flesh them out, do as much as you can. I will also say that in addition to Keisha, we do have another SBA. I don't know if we have any they're located, we have two things. We have SCORE. SCORE are actually retired business people that actually will read over your stuff. We have the Business Development Technology Center out of SVSU. That was once housed at Delta, but is now at SVSU. And then we also have the CMU RC, which is located in SBRC. That you can actually go there because they have so many small businesses up there but they also have experts that are also walking through there and helping people with their business plans. You can sign up. There is a cost attached to it. You can sign up for a membership and you can use all of their services and talk to people live, just boom. And they also have Saginaw Soup, which is an opportunity that once your business is up and going, you can actually, they had a competition where you can actually pitch your business idea to them and get money and get like a year worth of services. So there are a lot of opportunities in our community for small businesses. And then I will also say, don't forget to join organizations that's considered in your industry. Get attached to people that are doing some things outside of Saginaw, outside of Michigan, and even outside of the United States. Because people are doing some global stuff, and you can learn a lot of things that are actually happening that will help enhance your business here in the city of Saginaw. So again, thank you for such a great opportunity to serve you all in this capacity. I have enjoyed working with you all and sharing information. So Keisha, back to you.
Thank you again, Miss Michelle, for all your services and everything. We really appreciate you. I have emailed you all an evaluation. If you could fill that evaluation out and return it to me via email, that would be great. I put in there's a couple of questions where you score from 1 to 5, and then there's a box, an area that's available for comments. And then some of the questions you just answer, comment in the box to the question. So if you could complete those and return them back to me, that's very helpful. So since we have a little bit of time, was anyone aware of SEDC before this workshop? Did anybody know of SEDC? Paul says no. Lisa says yes. Miss Violet? Okay. So, Paul, do you feel now as though you're aware of what SEDC possibly has to offer? Do you have an idea?
Absolutely.
Okay. All right. So, because the goal is to bring awareness to SEDC and the resources that we have and the funding that we have available here in the city. Because I always say, when I came aboard to SEDC, as the coordinator, I wasn't aware of SEDC. So I was like, wow, this is the best kept secret. So that's what I always say. It's the best kept secret here in the city, that we actually have this program that's so resourceful and has so much funding available to small businesses that are located here in the city. So great. I'm glad to hear that you're aware and more, comfortable with SEDC. If you guys have any other questions about SEDC, does anybody have any questions now about SEDC that you would like for me to answer, or comments, or?
I don't know. Oh, go ahead, Lisa. Yeah. Go ahead.
Is that Lisa? Did you have a hand up, or Violet?
Yeah, Lisa. Go ahead.
She's saying go ahead,
We
Lisa.
both did, so I think Lisa's just being more patient.
Oh, okay. Go ahead, Lisa. We'll let you go first.
Yeah. Anyway, I accidentally came upon this since I'm from West Virginia. I think Eventbrite sent me a invitation is how this came about, I think. Paul, as far as what you were saying, one thing I thought about is you really can't put all of your products in a car and expect to get all that money back, because it can't be greater than the value of the product with the things on it, in terms of coming your money back. What about, and one other thing is, what about smaller items? Like, can you take this paint, and I'm going to offend you and not mean to, but can you take this texture and painting, whatever it is that you're doing, put it on a smaller item with your name and logo that you can give out, like a coaster, a metal coaster, or a, something like that, so you can, get it out to people in their hands?
I can. It's just that we build on planning a race car either way. So we were going to try to, I don't know if I could sponsor it or completely depreciate it, but like I said, I just wanted to pick a little more information. But we do have some smaller things, and we got a couple ideas we're kicking around for like little promotional stuff. I've been doing a lot of what do you call it, like the tumblers for like coffee and water and stuff like that. So I got a pretty good sale on those, and like I said, I just been kind of handing them out and promoting.
And if your plan doesn't work on your first pitch and you see that it's costing more or something changed, then change the plan before you go to the next place that you're looking for. And when she said it's a living document, it needs to be updated. Don't continue with the plan that shows that you're not doing what you thought you were going to do. Is that how you all do it, Keisha?
Yes, definitely. So, Paul, there's always room for improvement. So, as Michelle stated, the living document, meaning that there's always room for change. You can always go in and make adjustments to your business plan. If you find that you put something in there and maybe that's not working for you, maybe you need to make an adjustment. Maybe it's like you said, if you're doing an actual whole vehicle, of course, it's going to be more costly than doing maybe a piece of something, same material that a vehicle could be, in order to show the different textures and styles of the paint, so they can get an actual visual of what that paint would give, what type of texture, what type of look. And so maybe you would change your business plan to say that you have samples of different textures and paints and things of that nature, so that they can actually see what it would look like on a vehicle. So that may be something you may want to adjust to, and then that would be a cost saver as well, because you always want to look for ways that you can save dollars, of course, because then at that point, then that in turn makes the business more profitable.
I just wanted to tell you guys, thank you. The class was perfect timing for me. I have learned quite a bit of info. Um, you're definitely taking me back to a couple of accounting classes in college right now. So gotta go back and like study a little bit. But I'm hoping once I get my business plan kind of written out, if I could possibly forward it to you and Michelle, just to take a look at it and see if I'm missing something, or should I go back and add something in the future is what I'm hoping. So thank you guys. And Michelle, I just love your energy. You're so upbeat. So, and you guys know your stuff. So thank you guys for all your help.
My pleasure, Miss Lisa. Thank you.
All right, great, Miss Lisa. And I know Miss Lisa from school as well. So it was definitely an honor to have you aboard with us. It's an honor to have all of you. I see Miss Sabrina put in the comment what Lisa said. So let's give her a round of applause for every attendee and the presenters on today. So definitely, I definitely appreciate you all being here, taking out of your time, because we had a lot of people to register, but then, some people didn't attend. So it's definitely advantageous to you all to take advantage of this opportunity. It's something that we'll be offering. We're hoping to offer more on a quarterly basis. We'll see. My goal is just to get more awareness out there and for people to be aware of what SEDC does and what we offer and the opportunity that SEDC offers. So that way that small businesses know we're here, and we're looking to help, looking to grow some businesses. And you guys, when you get your business plans done, no problem. You can go ahead and forward them to myself and Michelle. I'll forward them to Michelle. Definitely give you some feedback on what we think, or what, critique it. Maybe you can make some changes here or there. I'm sure she's seen several. I've seen several. Like Michelle said, I'm not an expert, but I can definitely give some explanations and speak to some things. And so she said definitely it would be a pleasure as well for her to critique some of those business plans if you all would like. All right. And so Ms. Violet says, thank you for allowing me to be a part of your group and participate. It was fabulous. I am doing a strategic plan for an outside agency in January. Keisha and Michelle were great. I enjoyed the group. All right. Thank you so much, Miss Violet. We really appreciate you. See, Miss Violet, LinkedIn, and she took advantage of the opportunity, and she's not even in the area. So now that's what virtual does for you. So, going forward, you all have my information, should have my email address. My phone number here at SEDC is 989-759-1395. If you have any questions, comments, concerns, maybe you just need some help with something or some advice, definitely, I'm always open and available. Give me a call. Any way I can help, I'd be welcome to. So with that being said, I guess that concludes our 4-week session. It flew by, very informative.
Was it recording?
Yes, it did record. So we did record the 4-week session. Thank you, Michelle. So you can go back on YouTube, on the City of Saginaw's YouTube page. So when you go to YouTube, you're going to go to the City of Saginaw, and you will see these 4 sessions. So those 4 sessions were recorded there, as well as I have a recording as well, Michelle. I forward you a couple of them. I think I still have last week's and this week to forward to you. But so you can still use this opportunity as a resource. You can go back. Maybe, you say, oh, week 1, Michelle said something. What did she say? Let me go back and look and see, recall what she said. And, that way you can still use it, be helpful. And please go to that bplans.com. I went to that bplans, and there is some great information, wealth of information there. On templates on business plan, picking your industry, that helps you to say, oh, okay, so I can tweak it this way. Take it and tweak it and make it your own. And definitely that's definitely helpful as well. Did you have a question, Paul? Okay. Yeah, so that's bplans.com. That is a very resourceful piece that Michelle gave us. Thank you so much for that, Michelle. So with that being said, please, if you could send those evaluation forms to me that I emailed to you, I will be grateful for that. And again, if there's anything we can do to help in the future, please let us know. All right. Thank you guys so much.